Did you click on this video because you're thinking about selling your business and you're asking yourself, how much is my life's work really worth? My name is Garik Tate, and I help businesses get acquired at higher valuations through AI development, hiring elite top talent, and operational automation. And today, I want to guide you through how a buyer is really thinking about your business before they give you an offer. And more importantly, we're going to be answering the question of how do you make your business more valuable for a potential acquisition. First of all, welcome to the new studio space where the view is better, the design is more minimalistic, and the background was 100% easier to make. Anyways, let's dive into how is your business being valuated by a potential buyer. Well, you probably know that the standard operating procedure is to give you an offer that is some multiple on your business's annual revenue or profit. So if you earn $5 million a year, let's say that you can sell that business for a 5 times multiple, you'd be able to sell that business for 25 million. But what determines the multiple that you're going to be offered? Well, it depends on many different factors, from your industry to your company size to whatever are the idiosyncratic things that the buyer is going to be looking for. And so I want to be proposing an alternative, what I think is a simpler and more effective way of thinking about your business's valuation if you're looking at it through the buyer's perspective. And it all boils down to this simple formula. Your business's value is determined based on its future profit minus potential risk minus additional required investment. Let's break that down. First of all, your future profit. This is an important distinction. Your business is not really valued based on its past performance. It's valued based on its future predicted performance. Now, importantly, nobody can predict the future, least of all investors. But the best guess investors and acquirers have for your business's future performance is based on its past performance. What they're looking for is a stable profit that is preferably growing over time. And what they're going to be also looking for is how much is there untapped growth potential in your business. Often that boils down to, does the buyer have some sort of competitive advantage that they can merge with your business? This is why very often you'll be offered more money for your business if the acquirer already has some competitive advantage inside of the space. And importantly, it's not just your business's future earning potential, it's your business's future earning potential under the new management. Now, that cuts both ways, negatively and positively. On the positive side, if you're being acquired by a strategic buyer, that is someone who is buying your business strategically because they have some sort of competitive advantage to merge with your business, that's going to look very different compared to being purchased by a financial buyer who is someone who basically has capital to throw around to be making bets, but they're not someone who's really specialized inside of your niche or industry. And so the buyer is buying your future profit, but your future profit has to be discounted by the amount of risk that they are willing to take on. Now, risk can mean a lot of different things in a lot of different contexts. I want to talk to you about 2 major pieces of risk that if you can mitigate, it will dramatically increase the value of your business. The first type of risk is a single point of failure. Does your business have a single point of failure, either amongst your customer base or marketing channels? If you are selling all of your services or products to a single marketing channel, what happens if that marketing channel goes away? What happens if the YouTube algorithm changes? What happens if Amazon goes out of business tomorrow? Now, some of those things are more likely than others, but these are the types of risks that a potential buyer is going to be thinking about when they're going to be acquiring you. So it's much better to have a diversified set of customers or a diversified set of marketing channels. The second single point of failure that you should be considering is, are there any single points of failure amongst your employee base? And when you're looking at that, of course, you have to be including yourself as an employee in the business as well. Are you a single point of failure? If you get taken out of the business, does the business crumble? What about your top 3 performers? If they're taken out of the business, what happens? And the third area that you want to be looking at for single points of failure is amongst your vendors or providers. Are there any vendors or providers that you rely on that you cannot replace? If so, then that's going to have to be a discount on your business. Or another way to say it is, if you can solve that, your business is going to be sold for a higher multiple. Another source of risk that buyers are considering when they're looking at your business is, how defendable are your financial reports? When they are buying your business's future income, how much can they be sure of that financial future based on your financial past? That means, is your income something that spikes up and down very randomly? company and therefore it's unclear what the future holds? Or are your financial numbers something that don't really add up? Have you been audited? Have you paid someone to audit you? How rock solid are your financial reporting figures? The better your financial reporting, the less risk the buyer will be taking on when they're purchasing your company. Now, risk is not the only thing the buyer is discounting your business based on. The other factor that the buyer will be thinking about when they're thinking about acquiring your business is, what is the additional required investment? There's two ways to break this down. One is your opportunity cost, and the second is how much working capital does your business require. Let's take the first one. A buyer will be wanting to buy your business as a cash producing asset. They don't want to be buying a job, and they certainly don't want to be buying your job. And now this really is the crux of what most business owners run into. Most business owners out there, frankly, aren't true business owners. They're very well-to-do, self-employed people. And so you need to be factoring that in. Is your job really so good that someone will want to be paying you money in order to be taking it on? If not, then you need to make sure that your business is something they can run without, because the buyer wants it to be able to run without them also. The second factor is your business's working capital, because when the buyer is going to be buying your company, they also have to be funding whatever working capital is required to make sure that business runs. And they have to be spending both money out of the same checking book. And so you want to make sure that your business is very cash rich, that it's something that can sustain itself very effectively. And that's it. When a buyer is looking to buy your business, they are buying your future profit minus risk minus additional required investment. Now, what can you do in order to increase your business's value? It's very simple. Gain evidence that your business's future performance will be going up based on either past performance, or prove somehow that you have untapped potential. De-risk your business as much as you can by removing single points of failure, and by also making sure that your financials are well reported, and make your business a well-oiled machine that when someone buys it, they will be buying it as a cash producing asset that doesn't require a lot of input. What my team and I do is we help businesses de-risk and also increase profits by adding AI into their systems and processes so they can scale quickly. If you're curious about how we do that, click on the video here or in the description below. In this video, I walk through the engineering mindset and explain to you with examples how we break down a company's business processes to find the right areas to add AI in. I'll see you there. Thanks for watching, and if you want to know how you can amplify your business with AI, you can click on the link below and that will take you to 5 case studies showing how we've implemented AI across our businesses.